Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So recently the community have been asking me to look into individual stocks, and if you would like me to look at some individual stocks, just put it on the comment section. Inshallah, I will look into it. And in today's video we're going to look at one of the best companies out there. This quiet giant processes the paychecks of 1 in every 6 American workers, and it still keeps growing. While everyone chases basically the tech stocks and so on, this company has been in existence for like 70 years, and it's still quietly compounding cash year after year. And the company we're going to talk about today is ADP. ADP isn't a flashy company, but is one of the most consistent dividend machines on the planet. They have been increasing that dividend for over 50 years. So I'm going to share with you guys some of the details about the company, and of course then we will look at the financials. So what makes this company great? We'll look at the dividends, we'll look at the revenue side of things, we'll look at the EPS, the expected growth moving forward. We'll compare with the S&P 500, we'll compare other companies within the same sector and so on. So we got a lot to do in this video. So all I ask you guys to do is just like the video and subscribe to the channel. And if you haven't joined us at the Patreon account, please do so, because it makes a huge difference. I think one of the reasons people have asked me to look into this company is because for the 1 year it's actually down almost 4%, and it's closer to the 52 weeks low than actually anywhere near the 52-week highs. If you look at the year to date, it's down about 4%. In the last 6 months it's down 4%. For 1 month it's down 2%. For the last 5 days it's down 1%. So it hasn't done well at all since the basically beginning of this year. And we want to see where the company is heading where it's been and where it's heading, of course, in the long run. So let's have a look at some data from the company's website. And again, if you are new to investing, it is always a good idea to go to the company's website. There's a section called Investor Relations, and that will give you information, all sorts of information about the event, presentations and things like that. And this is the one I'm looking for now. This is basically in data that they've released August 2025. So I'm just going to use some of this information to give you an idea of what the company does, and financially how stable it is. So there's a bit of information about the company and so on, but this is the sort of a kind of gives you an overview. It's the world's largest HCM organization. So HCM stands for Human Capital Management Organization. So as you can see here, for the fiscal year 2025, they made $21 billion in revenue, total revenue. They've got 1.1 million plus clients. They've got 78 million employee tax statement processed. Like I said earlier, not only in the US but around the world, this company processes the paychecks of 1 in every 6 American workers. And this, of course, the company has been around for quite some time. And the other things that also they do is, when anyone gets hired, ADP wins, and when they get fired, they still get paid. So it's one of those companies that are in the right industry, and that's why it has a wide moat, and it's quite difficult to switch from this company to any other company out there. So you've got a lot of information here. You can just pause the video and have a look at it. But 80% plus of the Fortune 500s are clients for this company, which is quite interesting. Then you've got the segments within their business, so supporting every client HCM need. So when it comes to HR, when it comes to payroll, time, benefits, HROs, to talent, compliance, retirement, they touch every aspect of each business. So they work with all of these businesses, taking care of their HR, taking care of payrolls, they basically automating a lot of their systems and so on. They work with a lot of small businesses, a lot of mid-markets, up-market if you like. That's about 10,000 plus employees and so on. They are also around the world, 140 plus countries and territories. And as you can see, that it looks like basically they've got, what they try to do is basically purchase any companies. For example, in the UK, they might have a company that's doing all that sort of things. They purchase that company and they leave them alone, so it becomes part of that, basically their ecosystem, if you like. And there is more information, something to do with regards to the timeline of whatever years was happening over the last few years. And then you've got some information about the business side of things. Then you've got diversified revenue portfolio, so the breakdown of each segment within their portfolios and the percentages of that. So you got a lot of information, and one of the things that I like is the history of the durable growth. So from 2015 having about $10 billion or just about $11 billion to right now 20 something billion dollars, which is absolutely amazing. And on top of that, you got more information of their type of client. So client long, client short, client extended, and so on. And then the bit that I want to get to is this part here, because this is something that as an investor that's very, very important. And I like when companies put a lot more emphasis on this type, because we're looking at how, you know, you invest in these companies, you're going to need some sort of returns, right? So you get your capital appreciation. On top of that, the company is buying back their own shares, which means your one share right now is worth more if the company buys back their own shares. So the less shares out there, the more you own of the business, which is absolutely amazing. On top of that, you get dividends, and this company has increased their dividend for 50 plus years. So they are now a dividend king. So they actually are very, you know, proud of that. And I like the fact that, you know, 30 billion cash returning to shareholders in fiscal year 2015 to 2025. So over the last 10 years, $30 billion, that's quite a lot of money. And on top of that is the credit rating side of things. This company is probably one of the strongest out there. They've been winning all sort of, you know, awards and sort of things, but this is also important for me. Revenue growth, they're expecting to be about 6 to 7%, which is basically what you expect from this company. Adjusted EBIT, for example, 8 to 10%, which is decent. 9 to 11% when it comes to EPS growth, which is nice. And then total shareholder return is about 11 to 13%, and that is dividend yield of, so assuming 2% dividend yield. On top of that, they're buying back their own shares, which is quite nice. Now we're just going to carry on and look at a little bit more information about the company. We've seen the dividend yield over just 2%. Right now, valuation is saying reasonably valued, 97% when it comes to that dividend safety. AA minus, basically credit rating, or very strong. 114 billion market cap. So it's a huge company. And when it comes to that payout ratio, is only 60%. They've increased that dividend for 50 years. Like I said, 51 years right now. Latest was 10%. The last 5 years, about 11.3%. And last 10 years, 11.9%, which is quite nice. And it is growing massively every single year over the last whatever years. And I don't think that's something that's going to stop anytime soon. $6.16 is what you will get for every share of this company that you own. And the fact that it says reasonably valued right now is because of the 5 years. That line is below that, you know, that blue line is coming down, and it's quite interesting to see how, well, if the overall market comes down, I think it will hit massive undervaluation soon. So I'll share with you guys the valuation side of it in a second. But as you can see here, when it comes to the dividend yield theory side of things, basically used to be about 2% over the last whatever years. Right now 2.19, so that means it's undervalued at this point in time. When it comes to the 5-year growth and average for the PE, 28.6. Right now it's 25.8, which makes it undervalued as well. Looking at the payout ratio, it has declined, which this is expected to decline, which I like to see. So below that 56% will be absolutely amazing. The earnings per share for the last 10 years, look at this, $3.26 something to right now over almost $11, which is absolutely huge. Free cash flow per share also has been growing the right direction. Shares outstanding is declining every single year. Total sales is going the right direction, but it's not massive. And return on equity 76%, which is absolutely crazy. Return on invested capital 28%, and operating margins of 26%, free cash flow margin of 21%. You will not find many companies out there. These metrics are very similar to companies like Visa, MasterCard, and so on. That is the type of business this company is. Very efficient business, very well run. You'll know companies are very well run because of the return on equity and return on invested capital, because that the money, the company, the management is doing a great job in using the capitals that's available to them to generate more profits for us as as investors and so on. And now switching things to fast graph. So as you can see here, we're on max here since 2006 up until now. As you can see, this line here is the blue line, is what the master market likes to trade this company, and this is the operating earnings at 15 PE, if you like. So this is where the company should ideally, the price of the company should ideally be, but it's been, of course, trading way higher than that over the last sort of years. And this basically sort of a gold line here is the dividends, if you like. So it's been growing every single year and expected to grow, which is quite nice to see. When we add the price, this is where it becomes a problem, because we want the price to be around this line, because it's supposed to, price supposed to track the earnings of the company. And when it's not, that's when it becomes a problem. And when these two are not together, that's when it's basically the stock potentially might go down, and people will just lose a lot of money. People will lose the faith in the company and all sorts of things. So if we add price, watch what happens. The only time this company was undervalued or basically fairly valued, it was basically 2008. Since then, the stock has been going up. Even 2020 when COVID happened, it came down a lot, but it actually never touched that orange line here, which is what was basically 15 PE, if you like, the operating margin earnings, if you like. And since then, it's always been overvalued. Even if we reduce that timeline of the last 10 years, you can see how disconnected that is. And if you were to buy this stock right now, of course, you will be potentially, according to this, you'll be losing money. However, if we use the normal, which is this line here, as you can see right now, it's below that line. Potentially, it will tell us that it's actually undervalued. So if we use the estimates, which is that 9%, 10% sort of, and expectations moving forward, and you bought this stock right now, you'll be losing about 22% of your money. So your 10,000 will become 7,700. If you use the normal multiple, which is basically what Mr. Market likes to trade, and is below that blue line, which is basically what Mr. Market likes to trade over the last whatever years, and you bought this stock right now, you'll be making about 40%. So $4,000 off the top of the 10,000 you initially invested. But that 28 PE is I don't think is realistic enough for this company. One of the reasons this company has been overvalued over the years is because it actually beats the S&P 500. So if we look at since 2005, okay, so the last 20 years, the company actually has beaten the S&P 500. The S&P 500 is only returned just closer to 10%. This one is about 12%. So your 10,000 investment in 10 years ago would be right now 84,000, let's call it about 85,000 USD in comparison to 55 for the S&P 500, which is quite interesting. And then if we go ahead and compare this company with the similar sort of companies in the same industry. So this one here, Paycheck and then Paycom Software, both of them are sort of a similar industry as well as the S&P 500. So if we look at the last 5 years, and we are now looking looking at total returns. Total return is the price appreciation as well as dividends. So those, it includes both. So here we've got about, let's say, 29% in the last 3 years total return. 81% the S&P 500. So the S&P 500 is beating the company over the last basically 3 years. This one here, 23%, very similar to this one. And then this one here is of course in the negative. If we look at the last 5 years, 114%, 94% for the S&P 500, and these two is still trailing. So the company's done really well to be the S&P 500 in the last 5 years. So if you bought in 2020, you would actually have beaten the S&P 500. I think I bought it in 2021. I'll check again. But that's the time I bought, and I'll share with you guys how many shares I own of this company and so on. But over the last 10 years, 307, 200 the S&P 500. This one is done really well, but this one is just almost similar. So it has beaten the S&P 500 over the last 10 years as well. And although this one has done really great job and things has been overvalued at some point, it has come down quite a bit. But yeah, the company has done generally a great job. Now I'm just going to show you guys the earnings expectations moving forward for this company. So if we say June 2026, we're expecting about 9% year-over-year growth for when it comes to revenue. When it comes to EPS 2027, about 9% again, another 9%, just 3%, but there's only one basically analyst looking at that one. When it comes to revenue, that 6-7% is what you normally get for this company anyway. And that's what you're getting for the next 3 years and so on. So this is not, high flying stock, and you want to buy it when it's undervalued, because you get that, that bit of a price appreciation. Top of that, you get the dividends that's still growing, and the top of that, you also get the, share buybacks, which is absolutely amazing job. The company's doing an amazing job of buying back their own shares, like we have seen here. And then final thing before we talk about valuation is the free cash flow here. So 2022, the company has $2.5 billion. Then in 2023, we're looking at 3.6, 3.6 again, 4.4 or 4.3, whatever you want to call it, and that's where we are in the trailing 12 months. So it is growing free cash flow. So the company has enough free cash flow to buy back their own shares, to pay off any debt, to increase that dividends, to reinvest into the business, to acquire other businesses. So there's a lot of things that they can do with that money. And final thing I want to share with you guys is the valuation side of things. And if you look at this here, with this comes from Morningstar, so $305 per share is where they think the price should be. Simply Wall Street is saying 386, Seeking Alpha 318. I used the dividend discount model as well as multiple valuations and discounted cash flow model, which is kind of gave me similar sort of prices to what these companies have come up with. That gives us intrinsic value of right now $324 per share. The stock price right now is $281 per share. So that gives us basically right now, it seems undervalued. You might want to say I want to give myself 10% margin of safety sort of thing. $292 per share is where you should be buying that stock. If you feel like, you know what, this might be very risky, which I genuinely don't think it is, okay, then you can buy this stock when it hits $276 per share. That's about what, $5, but then lower than where it is right now, and with the current market that could easily happen anytime. So that is basically everything I wanted to share with you guys. The final thing I want to do is share with you guys is just show you how many basically I own of this company. Right now I'm up about 13%. It was slightly higher than that, but it has come down. So if for the 1 year, I think at one point the price was about $326 per share. It has come down quite a bit. I think at one point I was over $1,000 when it comes to that, £1,000 when it comes to that gains. I do own 25 shares, so if it hits that sort of right now $233 per share is my average, is very close. So if it comes down to even what did we say here, even if we get to 270, potentially I will be buying a little bit of it. So I wouldn't actually hesitate buying, even though I'm averaging it up, I will definitely be buying. Final thing I want to share with you guys is I'm just looking at my phone, and when it comes to Shariah-compliant side of things, when it comes to the business activity screen, is 98% according to Zoya, according to the compliance things that they use, the AAOIFI. I know the company, some websites out there say this company is not Sharia compliant, but every time I read their information, they've never been satisfied with some of the things that they've said. When it comes to interest-bearing debt, is only 7%. When it comes to interest-bearing deposit or securities, whatever, 6%. So there's absolutely no concern from my side. I've owned the company for quite some time, and every time I look into their business, I've never come across anything that is basically out of the ordinary or anything that I felt like is not Sharia compliant. So I don't know where that information comes from. But yeah, that's me. That's everything I basically wanted to share with you guys today. If you are enjoying this type of content, don't forget to join us in the Patreon account, like the video, subscribe to the channel, of course. Have a wonderful day. Assalamu Alaikum.